The Federal Reserve is holding its two-day meeting and is expected to make a decision tomorrow on interest rates, with signs pointing to the first cut since the end of last year. The current rate sits at 4.5%. Joining us live now, Paul Lane from the Armstrong Advisory Group. Paul, it's great to see you. Thank you for your time today.
Thanks so much for having me.
So let's talk about a few of the factors here that go into the decision: job numbers, inflation data. So what are your early thoughts on where the Fed might be leaning today?
Yeah, so it seems like they are going to go ahead with a 0.25% cut tomorrow at the Federal Reserve meeting. Probabilities right now indicate that there's about a 96% chance that we do see that cut. The reason behind that is largely the labor market. While there are certainly inflationary concerns out there, what we've seen from the labor market is the unemployment rate has ticked up to 4.3%. We also had a revision taking away 911,000 jobs from March of 24 through March of 2025. So there definitely are signs of weakness there, and that is what is predicated behind this rate cut and really reinforces this decision that the Fed will likely make tomorrow at 2 o'clock.
And Paul, some of the ancillary factors here, let's talk about consumer spending, for instance. Though you could argue that is strong if you look at the category of spending here, higher earners. And we are headed into a holiday season too. And the market itself, it has grown some 40%-ish after those spring tariff fears. So there are those things that exist now too. So if there's a quarter cut made as you think tomorrow, what does that do for the right now? Talking mortgage rates, car rates, credit card rates, hiring projections, frankly, for the next few months.
Yeah, so on the consumer side of things, what you'd see is your money markets and CD rates at your local bank. Those are likely going to come down by the commensurate, 0.25%. So that will be the impact to consumers. On the lending side, if you have a home equity line of credit or credit card debt out there, that should hopefully come down too. So that is a benefit for those who are borrowers out there. In terms of employers and businesses, the idea hopefully would be that the cost of capital in order to borrow would be cheaper, and with cheaper financing, perhaps there would be an impetus to grow your business more. But a 0.25 basis point cut is just a start, so I wouldn't say that it is going to be transformative to any business out there just yet.
And with you just saying that, we know that President Trump has been very vocal, saying that the Fed is behind. Quarter cut might not be enough. He's pushing for more. What do you think could trigger potential more before the end of the year?
You do have several appointees that President Trump is trying to push through on the Federal Reserve Board. There's 12 members that make up that contingency that make that decision. So perhaps there's going to be more pressure applied from those Trump appointees to cut rates down a little bit more. Outside of that, you'd have to see the labor market weaken significantly if we were to see more cuts in the future. There are projections for another rate cut before the end of the year for another 0.25%, but to see more than that, I think you'd really need to see the unemployment rate tick up to 4.5+%. Right now, we sit at about 4.3%.
And we know investors certainly waiting, watching for this decision to come. And let's talk about this potential buyer for TikTok. That's a pretty big deal going on. So the market's already showing that it really wants to hold here. It's had a good few weeks, couple bouncy days notwithstanding. But what do investors really want to see here now to surge potentially this market even higher?
That's a great question. Certainly, the Federal Reserve interest rate cut, that has been an impetus for some of the recent market activity that we've seen. It seems like Wall Street has liked the idea that borrowing costs are going to be lower. What they need to continue to see is the resiliency of the consumer that you alluded to earlier, that's going to power earnings growth. And of course, the AI story has been instrumental to the market this year. They need to continue to see those big hyperscaler companies like Microsoft and Nvidia and others spending and generating a lot of revenue. Those would really be the two biggest factors: the consumer still spending and the AI momentum. That's what would help propel the markets further and hopefully keep them, at bay for the moment.
Okay, great discussion, Paul Lane, Armstrong Advisory Group. Pleasure to see you today. Appreciate your time. Thank you.
Thanks, guys.